Good afternoon, everyone who has been able to join. So, over the next 30 minutes or so, let me just uh, touch upon the basics of what the venture capital ecosystem looks like and how does actually deal making process happens in this ecosystem. So, we will be covering the following topics throughout our presentation. So, one is basically just understand who are the critical participants in the VC ecosystem, and then how has the ecosystem as a whole evolved in India over the past decade or so. And then we look at VC ecosystem in terms of the stages of investments and how does that evolve with different growth of the startup. We look at the VC deal making process of which all the critical decision parameters that goes into valuation of a deal. And then despite all that deal making process, why do still the investment in the startup fails to achieve their expectation? And lastly, we look at what are the critical skill sets that are required to be a successful VC investor. Some of you who have been able to join this call may already be know certain aspects of this discussion, but I would still like to point out that these are critical insights and therefore would still like to brush upon them. So let's start on the journey. uh, Understanding the VC ecosystem, basically there are critical 5 or 6 participants in this ecosystem, apart from obviously the venture capital and the startup. So other element is limited partners. So they are basically the capital owners who provide money to this venture capital fund, who are basically capital managers. Venture capital funds then invest their pool of capital into multiple startups who are basically value creators. And once the startup grows and is able to achieve its business, venture capital fund is able to secure an exit, and then that money is again pooled and returned to the limited partners. Who are these limited partners? They are basically in the form of 3 4 categories. One is your development institutions like International Finance Corporation, Development Finance Corporation, or SIDBI, or they are basically sovereign wealth funds of major economies like Singapore, Bahrain, Qatar, Abu Dhabi, or European nations. Last category is basically rich individuals like HNIs and family offices, which have huge surplus to invest and they want to invest in venture capital funds. Obviously, these are some of the venture capital funds that have been listed out. These are the leading names in India. I'm sure some of you might have heard about some of those listed here. Startups, there are basically classified into 15 plus sectors, with some of them being fintech, edtech, personal care, and the list keeps on growing, like new categories like climate, SaaS, generative AI. So the list is quite exhaustive and ever expanding. However, the point, the startups that have been created in India, only less than 10% have been funded by VCs. So it's not that a startup who gets funded by a VC is successful and the others are not successful, but uh, only 10% have been able to manage to secure money from VC funds. Then there are two other entities which are equally important in the ecosystem. One is investment bankers. They basically are the deal makers. They help connect startups who are looking to raise funds and venture capital who are looking to deploy funds. They act as a bridge between them and help them in creating the thesis during the documentation process and also reaching out to multiple investors. Similarly, there are multiple advisors who are also equally important in the deal making process. Some of them are legal advisors. When a VC funds decides to invest in a startup, there is a long documentation process that happens. And for that, legal viewpoint is critical. And legal advisors at this point of time become very good partners. Then there are due diligence partners like the big four, multiple financial and legal due diligence providers who are equally important during the deal making process. Now, the three critical participants in this ecosystem are the LPs, the venture capital funds, and the startups. Now, what is the expectation of these participants? LPs, as I mentioned earlier, are basically the owners of capital. They have a lot of wealth and they want to diversify across different asset classes, with VCs being one of them. They basically expect a 15 to 20% IRR on their expectation on their investment, and they are also looking at co-investment opportunities. So basically, when these LPs invest in a VC fund, these LPs do not have access to all the startups in a particular ecosystem. So they would want that whenever a VC fund in which they have invested, they allow the LPs to also invest directly into the VC fund, so that LPs can have two sort of exposure. One is through the VC fund, and other is directly on the startup. VC funds, as I mentioned earlier, are basically the managers of capital. They work between limited partners and startups. They basically earn 1 to 2% of the AUM as a management fee on an annual basis. And they also get a 15 to 20% carry. So basically, 15 to 20% of whatever profits that the fund generates and not a deal generates, they basically keep that share, and the remaining 85 to 80% is returned back to the LPs. VC funds are basically a long tenure funds. They have 7 to 10 years tenure on an average, and basically out of the 100, let's say 100% allocation that they've raised, 60 to 70% goes towards investment in new deals, whereas 30 to 40% is for follow-ons. Basically, you take 60 to 70% risk on new investments, and those out of those which are sort of breaking out, you invest the remaining 30-40% capital on those. Basically, known devils are better than new devils. So it's a new or an invested startup is already always better to invest because you know the startup, and therefore you double down on the breakout players. Startups are basically value creators. They not only seek capital, but also seek strategic assistance from investors in terms of reaching out to different pool of capital, reaching out to critical players in the ecosystem that helps them in the business, understand the business elements slightly better, and also be a sort of discussion dashboard that what should the strategy be going ahead on critical aspects of the business. And startups, it's not a journey which is decided at day one. They keep on pivoting based on their experience, what they see while going through the journey. For example, Zomato didn't start as a delivery platform. They basically started out as a listing platform for restaurants and for consumers to view the reviews. But they saw that monetization is difficult, and that's when they decided, let's pivot to a delivery platform. Similarly, Dream11 didn't start out as a fantasy league platform. They basically started out as an app where sports enthusiasts can discuss about various fantasy leagues and tournaments that are happening across the globe, and ad-based revenue was the main thing. But they noticed that monetization is difficult, and therefore they pivoted to creating their own fantasy league, and you know the story thereafter. So pivots are critical in a startup's journey, and let's look at how the ecosystem has evolved over the past decade or so. So, based on today's government numbers, in India, there are close to 1 lakh registered startups. That's a massive, almost 250x growth in the last 7 years. In 2016, there were barely less than 500 startups. Today, more than 1 lakh. And that speaks volumes for itself, because entrepreneurs are taking a risk on their sort of careers, on their sort of progress and all. And still, so many entrepreneurs have come forward and decided to do innovative stuff in India. And equally important is how the VC investments in India have evolved. If you look at the past decade or so, just look at the numbers. 2012 was around 3.1 billion. 2022 is almost $25 billion. That's almost a 5 to 10x growth in the past 10 years. And this is an annual investment. And close to 1,800 venture capital private equity players are existing in India today, which is almost 6x of what it used to be maybe a decade ago. And the bigger point is, even though these deal volumes and the quantum of investment into startups has increased, there is possibly $18 billion of dry powder available, which means that $18 billion of cash available with these investors, and they're looking for the right opportunity to invest, but they haven't invested right now. That's a massive sum, and that bodes well for the startup ecosystem. Uh, During the startup's journey, there are multiple stages of investments, which are typically classified into three stages: the early stage, the growth stage, and the late stage. Now, and with each stage, the funding amount generally increases, and the expectation is the valuation of the startup also increases in most cases. Uh, Now, if we look at the startup journey right from an idea to maturity, all the startups pass through this stage. So typically in early stages, when we classify that the startup has an idea, they raise a pre-seed round, and then they move on to the product development stage, wherein they need the money, then they raise the seed round. After they've developed the product, they need to scale in the market and establish a product market fit. That's when they raise a series A round. Now, once they've established a PMF, a product market fit, all they need is money for growth and market share expansion. That's where the growth stage investments comes in, from series B to series D onwards. After that, from series D onwards, basically the startups have proven their business model. They've proven that the product or service that they have works, and they need money for expansion. That's where mature stage enters and late stage investors come in. Now, typically, although there is a lot of overlap between what kind of investors participate at what stage of investments, typically at an early stage, angels, friends and families, and micro VCs are the ones that would initially lead the investment. Uh, at the growth stage, it's basically the bigger VCs and private equity players who come in, who have the capital needed to be deployed in the deal. And typically, in mature stage are large VCs, typically with an AUM of more than $500 million, and private equity players who would participate at this stage. Now, a VC deal making process has multiple steps, and it's basically classified into two uh, stages. One is pre-investment stage, one is before you made the investment. Other is the post-investment stage, which is basically after you made the investment. Within pre-investment, there are again five stages. One is deal sourcing, which is basically looking out for potential investment opportunities. Then is deal evaluation, which is basically evaluate the pros, cons, and critically analyze the deal. Third, and a very important aspect, is deal structuring. What should be the round construct and everything. Fourth is before you sort of admit or go through with the investment, you need to make sure that the startup, what the numbers they've been quoted, what the founders are saying, everything makes sense and is actually accurate. That's why you do a due diligence or a DD. And the last phase is the investment phase, wherein actually the document are signed and you disperse the money. Giving out money is the easier part. Post investment is the more critical element and the most difficult part, which is basically includes your portfolio monitoring. Out of the investments that you made, you keep a track of how the investments are going. You talk to the founders, you understand their numbers, you help them in the strategy to course correct if required. And the last and the most critical part is exit. As I mentioned, giving out money is easier. Earning on that money and taking the money out, which you ultimately need to return to the limited partners, is the most difficult part. And that's where most of the VCs struggle. Now, let's look at each of these elements in greater detail and try to understand what basically goes into it. Within pre-investment, the first step is deal sourcing. So there's a saying in the VC ecosystem: your network is your net worth. Basically, you need to source the next big thing before someone else finds it, and that's how you will be able to source a good deal. And typically, the best of the deals comes either from a network of investors or serial entrepreneurs who want to take your money, or former colleagues who are starting out and basically reaching out to you that we are starting up if you would like to invest. And this is the most important element of the VC investment deal making. It's basically if you put garbage in, you'll have garbage out. And if you basically if you invest in good deals, the likelihood of having a good outcome is much greater than a sort of a so-so deal. Therefore, deal sourcing becomes one of the critical elements in the entire process, and therefore, all the members of the VC funds are involved in the deal sourcing. Obviously, the time that they allocate to deal sourcing may vary based on your seniority. For example, junior resources spend close to 70 to 80% of the time just on deal sourcing. Go and reach out to various startups, your fellow investors, your already existing portfolio of investor or entrepreneurs or former colleagues. You just spend time on the road and try to look out for new investment opportunity. And as you go senior into the VC fund, your time starts to get divided between deal sourcing and portfolio management. The next phase, when you have at least sourced, let's say you sourced a deal, now you need to evaluate whether it's worth investment or not. And the deal evaluation is again a critical element. Basically, in evaluation, there are 4 or 5 basic parameters that you cover, which helps you give a broad sense of whether the investment is worth or not. First and foremost is the founding team. What kind of founders are they? What kind of skill sets do they have, and what's the pedigree? And the other important element is there a match between the skill sets of the founder and the startup that they have? Is there a sort of a relevance match between what skill sets that they have and what they're trying to solve? Other is market sizing. Basically, you have 3 elements of market sizing. Your TAM, which is total addressable market, which basically means the total market which is available. Your SAM, which is service addressable market, which is basically out of the TAM, how much is the serviceable market for you. And last is service obtainable market. So out of the total SAM, how much market share can you capture? And that should be your market share. So basically, if you could take an example of, let's say, a credit card company looking to launch new credit cards. So basically, for TAM, their TAM would be how many credit card worthy users are there in India. And let's say the parameter for that is you have a CIBIL score of more than 700. So that would give you a TAM that these many consumers in India have a CIBIL score of more than 700. And this is my TAM. Now, let's say this credit card company wants to launch credit cards only for foreign travel. For example, all the credit card users are not going to travel abroad, and therefore the TAM is not going to be equal to SAM. Service addressable market is, let's say, out of these credit card worthy users, how many users are potentially foreign travelers, and therefore I can target them. That's going to be your service addressable market. And once you figured this out, basically you put an analysis that, okay, out of this size of market, rationally and logically, how much market share I can grab based on your operational and your sort of expertise in terms of gaining the market share. That gives you the SOM. This 3 elements becomes critical in sort of assessing what kind of scale then can the potential investment opportunity reach ultimately, and that can provide you an exit. The third is differentiation. So out of the 1 lakh startups that have been registered with the government, not all have sort of differentiation. So the main parameter to evaluate differentiation is, if a startup is starting up, do they have any proprietary insights into what they are doing? Basically meaning that, does the founder know something or is doing something which no one else in the industry knows about or is doing? Do they have something critical about the industry which no one else knows? These proprietary insights become critical for success of the startup, and they also create entry barriers for the startup so that it doesn't attract enough competition. The fourth element is unit economics. Basically, does the business even make sense economically? So basically, you evaluate your gross margins, your contribution margin too, which is basically uh, how much money does the business make after considering all the operating and the marketing costs. Leave aside the fixed cost. Does the business make money? And if this contribution margin is a negative margin, then you have a critical red flag that after covering the operating costs, the business is not able to make money, and therefore it will never be able to cover the fixed costs. The last is EBITDA. Basically, I'm sure all of you must be knowing what EBITDA is, therefore it's self-explanatory. Uh, Fifth and a very critical element is exits. When I'm investing at an early stage, even though all the parameters that I've spoken about make sense, is exit is very important. Therefore, as an investor, you need to evaluate what kind of exit would you get, because ultimately, if you don't get an exit, you won't be able to take out cash from the startup, and you won't be able to repay the limited partners the returns. And therefore, as a fund, even though on paper you have very good performance, as a fund, you won't, no one else would be willing to give you funds, more funds to invest. Therefore, exit becomes a very critical evaluation parameter when evaluating a deal. The next is deal structuring. Okay, now I figured out that this startup is worth investing, and now I want to see the round construct. So basically, you see what's the pre-money valuation, which is before you make an investment into the startup, what kind of valuation is the startup commanding, and at what implied multiple. Multiple in most of the early stage investment is basically a revenue multiple, because most of the startups are EBITDA loss making or at best EBITDA break even, and therefore EBITDA multiple wouldn't make sense. Therefore, you see the revenue multiple. How is it as compared to previous transactions that have happened in the industry? Do they make sense? Who are you going to be your investors? Are you the only investor, or someone else is also coming into the same round? What kind of pedigree those investors have? That becomes equally important. And also, the investment that you are making, is it a primary or a secondary fundraise? A primary fundraise is basically the startup raising the money, gets the money. A secondary fundraise is basically an existing investor into the startup sells those shares to you. Therefore, the company doesn't get any money, but the earlier investor pockets the money. Therefore, you need to evaluate the money that you are putting in. Is it a primary and a secondary? And therefore, how much money will the startup ultimately getting out of your investment? Other is investor rights. So there are lots of things apart from capital that you're putting at stake. You need to know basically certain critical rights, that if a startup is raising the next round of funding, do you have the option to invest in that startup? Suppose the startup winds down, unfortunately, uh, and they still have capital. Who gets the capital first? So your liquidity preference becomes critical. What kind of information rights do you have? These are typically privately held companies. So you need to make sure that once you deploy capital into the startup, it's not that you end up meeting the startup whenever they want to. There has to be a regular communication between the startup and investors, and this everything is documented in the form of investor rights. There are multiple other things, which is why legal advisors become critical at this stage, which are one of the peripheral participants in the ecosystem. The next is due diligence. Uh, the startup and the founder has told you that these are our numbers, this is a product, this is a service, this is how we've grown over the past 2 3 years, and this is how we've raised money. You need to verify uh, whether what they're saying is actually true or not. And there's a standard practice for this. And this is covered in the financial and legal due diligence. Again, these are done by professional entities, which are again the part of advisors group that we have as peripheral participants in the ecosystem. And they do their work very well. So VC funds don't need to get involved into this. They basically see the outcome and then evaluate whether it makes sense in going ahead with the deal or not. Other critical element is a founder background check. You need to check whether the founder is he involved in any legal cases? Does he have any kind of backlog on his head, on his or her head, that can sort of affect your investment? Typically, you don't need uh, a founder which has a bad name in the industry for whatsoever. Therefore, you need to do a founder background check, and this is without the founder knowing that you're going to do a background check. This is sort of done confidentially. And the last part is, if everything looks adds up, if all the your deal looks interesting, your deal structuring is to your suiting your interest, and the DD comes clean, then you end up making the investment. And in this, you basically sign a couple of documents, which is basically your shareholders agreement, which is basically an agreement between the founders, all their existing investors, and all the investors that are coming into this round. And then ultimately you disperse the fund to the startup. So uh, even though investment sort of journey looks simple, there are multiple checks and balances that are there before making an investment that ultimately leads to a VC investing in a startup. Now this is basically a 20% job done. As I mentioned, most important aspect of deal making is getting an exit, and for that you need to monitor the portfolio. So post investment activities become very critical. Here basically you get in touch with your portfolio companies, keep track of how they're performing in terms of your MIS, which is management information system. You do quarterly calls, you attend board meetings, get to know how the startup is performing, and you also offer your assistance wherever required. And typically VCs offer expertise in 3 4 areas. One is they basically help the startup connect with other investors, either for a follow-on capital raise, or sort of just to know a viewpoint, or just to keep the contacts warm for the next round of fundraise. Other is hiring. uh, Startups are basically more riskier than a corporate job, and therefore the talent is also skeptical about joining a very early stage startup or even a startup that has raised funds. And therefore VC name becomes very important in sort of convincing a talent to join, that this startup is has already has the capital, it has a good track record of and a good background in terms of the founders and everything, and this is going to be a good journey. So VCs play a very important role in also convincing talent to join startups. And the other is strategy. Basically, as I mentioned, startup journey is not decided on day one. They basically start on their journey. There can be multiple pivots along the way, and for each pivot, it comes with experience of going through that journey. So VCs act as a discussion board for these startups to just discuss the strategies and what's working, what's not working, what should be the way forward. And that helps the startup decides the right way forward and also correct their past mistakes. Uh, Last element of the deal making process is an exit, and the most important element. There can be three kinds of exit. One is basically a strategic sale, wherein another larger player in the same space or an adjacent space acquires your startup. So for example, Flipkart was acquired by Walmart, Thyrocare being acquired by PharmEasy, or Carrot Lane being acquired by Titan. All these sort of acquisitions ended up uh, providing a huge exit to the early investors in all of these acquired targets. The other is secondary purchase. Basically, uh, new investor, new or an existing investor ends up purchasing your initial stake in the business, and therefore it's basically a deal between two sets of investors, and the company is not involved in this. The company doesn't get any money out of this, but it still provides exit to an initial investor. And the third is obviously an IPO. You've seen public listing of Mama Earth, Zomato, Paytm, and all of these have been able to provide an exit option for the early backers of respective startups. And typically, it ends up taking close to 7 to 10 years. In some cases, it can be earlier. In some cases, it can be much longer than this also. For example, in Mama Earth, investors made money in less than 7 years, possibly around 4 5 years. Whereas in Paytm, people had to wait more than 7 years to make money. So it depends, but typical investment horizon is close to 7 to 10 years for a VC fund. Now, after going through this entire journey, and in your head, you ended up making the investment thinking that this is going to be a sort of a game changer. but still there are reasons why that bet can still go wrong, and following other reasons why startups can go wrong. So there's a Pareto principle which is very applicable in the VC industry, which means that 80% of the VC's returns comes only from 20% of the deals, and these 20% of deals would provide such a big value creation that it will cover up for all the losses in the remaining 80% of the deals. And therefore, these 20% of the deals that are going to be your outliers become very critical. And uh, you need certain factors to work in your favor for you to achieve those kind of outcomes. There can be two sort of categories why a startup may not be successful. One is external factors. One is basic, and the biggest one is a lack of proper product market fit. This can be basically that you expected the market to be of certain size, but it ultimately wasn't that big enough, a scalability issue. Other is you expected your products or services to sell at a particular price point, but that price point was too high and no one was willing to pay for that kind of product or service. And therefore, there was a pricing issue. The other is your price was right, your market was right, but you underestimated your cost in providing that product or service. So your unit economics are not as expected. And therefore, there's a margin issue. If any of these happen, your startup is more likely to sort of underachieve their expectation. And all these sort of factors can be exclusive, or multiple factors can happen together. The other is intense competition. When you entered the industry, you were the only one. Probably there are very few players who are offering a similar kind of product or service. But eventually, if there are very low entry barriers, with your success, you attract more competition, and that's when sort of the differentiation that initially you perceived wasn't big enough. And therefore, with intense competition, you're above three parameters come into effect, and your startup can either sort of your pricing, there's a pricing issue, or there's margin issue, or you're not able to scale up to the extent possible. The other element is limited capital. You expected that you will be able to scale the startup to this level with this kind of capital, but because of the other reasons, the business sucked more capital than required, and therefore you're not able to sort of achieve that kind of scale that you wanted. And the last is regulatory changes, and this can happen anytime. For example, Dream 11 business was going very well and growing. uh, Suddenly there came a ruling that there will be 28% GST on the pool of capital that you use for betting. That suddenly changed the business model overnight, and these players are now trying to figure out what can be the workaround to do that. Similarly, SEBI and RBI are quite sort of observatory on the regulatory parameters for NBFCs and fintechs. They one day decided that your wallets cannot be loaded using credit card, prepaid instruments. Therefore, a lot of players like Slice and all ended up sort of they had to shut down the products overnight. And these regulatory changes can happen suddenly, or you anticipated them, but you didn't know whether they will ultimately come into effect or not. But you have to be careful before investing whether there are any regulatory overhangs in that particular startup or that particular industry before investing. The second category of reasons are internal factors. Basically, there's an execution failure. Either the team was incapable of execution because it was not the right skill sets for that particular startup, or the processes that the startup had were sort of not up to the mark, and therefore they couldn't execute to the best of their capability. The last is, and the biggest thing is fraud. There have been numerous recent instances where startups have misreported numbers, they have been wrongdoing. They have kept this under wraps for a long time. Ultimately, because they were not able to raise a follow-on capital, the existing investors deep dived and understood that a lot of wrongdoing had been happening. For example, there's a company called Mojocare. Uh, there's a company called Go Mechanic. They openly said that we misreported numbers to our investors, and that when they had to do a follow-on fundraising and when the DD happened, ultimately they realized that the numbers were fudged, the products were missold, and everything. So fraud is something that a investor needs to keep track of, and how to prevent is basically just have regular interactions with the startup and the founder and keep a closer track on the business. It shouldn't be that you are interacting with your portfolio company after, let's say, 24 months just to realize that, oh, last time when you had met, these were the numbers, these were the products, and now the startup has pivoted completely. And you don't know whether the numbers or what the founder is saying is accurate or not. So, therefore, uh, fraud still happens, even though investors don't like. But still, there is a way to work around that. Lastly, we've spoken about how the ecosystem is, how what's the process to make deals in this ecosystem. And these are the critical skill sets that if one has to become a successful VC investor, these are some of the critical skill sets would be required. So there's an anonymous quote that venture capital is a game of outliers with out of box ideas that give outsized returns, but with a long feedback loop. So basically, as we mentioned earlier, VC works on a Pareto principle. 80% of the deals don't end up making money for you. 20% of the deals will end up making 80% returns for you. And the worst part is you'll get to know which of these 20% deals will end up making only after a period of 7 to 10 years. There's a long feedback loop. So if you have to be a VC investor, you have to be very patient, and you have to be sort of lucky enough to identify those 20% deals which will give you outsized returns. So these are some of the skill sets that are critical to be a successful VC investor. One is you need to be thinking beyond what's already visible. If everyone has identified an idea that this is going to be a successful idea, it's not going to be successful, and that investment is not going to make money. So the critical thing is you identify what everyone else has not noticed, and therefore you need to think long term. Identify those game changers in terms of your startups, in terms of an industry, in terms of a product or a service that no one else is offering currently, but there is a latent demand or you see a big demand for that going ahead. If you're able to identify this, that's when you'll make big money. Those 20% of your successful deals will come from these kind of companies. The other is a very strong human capital judgment. Because you're investing at an early or a growth stage, you're basically making a bet on the founder. And founder and a startup match has to be critical. If you have an amazing idea, if you are presenting an amazing industry, but still, if the founder skill sets don't match with what are required to be successful in that industry, the startup is not going to be successful in most of the cases. Similarly, the founder might be really good. The founder might have an amazing idea, but are those the right skill sets required to be required by that startup to be successful? That judgment is what a VC investor makes in most of the early stage cases, because the numbers are mostly very short term numbers. Therefore, you need to make a judgment on the human, on the founder. The third is interpersonal skills. In this industry, we saw earlier, network is your net worth. So if you don't network with the right set of people, uh, your chances are you won't be a successful VC investor. And you need to network with founders, you need to network with fellow investors, and also with industry participants. That's when you get a pulse of what's happening in the ecosystem. That's when you identify startups that are starting about. That's when you identify or meet good set of founders. And this ecosystem is a small one. If you're not known to that ecosystem, no one is going to recommend a deal, no one is going to recommend a particular investment to you. So you have to be there in the ecosystem, and you have to have interpersonal skills in this ecosystem. Fourth is financial acumen. Obviously, story is a story. the story still needs to make economic sense. Therefore, putting the investment at the right valuation, also understanding the business in terms of their margins, their everything, the financial analysis is equally important. But I would say in early stage, financial acumen is obviously required, but you won't have that much data to work around with. Financial analysis becomes very critical at growth stage and late stage kind of investments. uh, the fifth is legal understanding. So, as we discussed earlier, in the deal making, an investor has a lot of rights that they need to have for the investment to go right, for monitoring the investment to get a good exit, and also protect against the downside. And you need to be able to negotiate on these rights. So, business negotiation becomes very critical. Uh, and understanding of the legal terms also is very critical when it comes to sort of making a successful investment. I feel over and above this, common sense is obviously a basic sort of table stakes for these. If you don't have common sense, if you're not able to work out the common modalities, these skill sets don't matter. But with these critical five skill sets, the chances are that you have covered the bases, and the chances to be a successful investor probability is quite high if you are able to find the right deal, if you are able to find the right idea, and if you are able to go through that process diligently and wait till you sort of reach that 7 to 10 years when you're able to see possibly your first successful exit. So I think, yeah, this is what I wanted to cover. These were some of the insights that I wanted to share on the ecosystem and how the deal making happens. Uh, Happy to answer any questions if you have.
So I wanted to know how much venture capital companies have control over day-to-day operations of the startups. Like in the case of Byju's, they did, as far as what I've analyzed, they have done huge marketing spends, and whereas the company was not generating that kind of revenue. So how much does the control has, or else how much decision-making authority does the VC has in day-to-day operations of a company or a startup?
Won't be able to generalize that because it depends on a case to case basis. But the thing is, any founder won't want the VC to sit on its head. They don't want them to be involved in day-to-day operations. They want some freedom. Obviously, VC would want to monitor the activities, but they also don't have the kind of bandwidth available to look at daily kind of activities. Therefore, they basically engage either on a monthly through the MIS that is available, or quarterly calls, and that works for both of them. Founders are happy that there is no one sitting on my head looking at overseeing me, which sort of affects the efficiency also. And at the same time, VCs are happy that at least on a monthly basis, they're able to get updates, whatever is required, and can discuss. Something that happened in Byju's is a case which I would say had multiple things that are going
Right,
on.
right.
One is basically lack of transparency itself. The other is too many investors, and if you raise too much capital, uh, obviously the founder has that kind of pedigree where they can say that investor that I will give you information
Right.
only on quarterly basis. You don't need to monitor me on a daily basis. But whereas for an early stage investor, let's say you are the only investor and the founder is, let's say, just started the company 1 month back. At that
Mhm.
stage, probably the founder would want that you get involved as much as possible and help him or her through that journey.
To establish. Yes,
But
yes.
Byju's is big enough and they don't need that kind of assistance. Instead, they don't need that kind of interference. So it obviously varies from a case to case basis.
Okay. Thank you, Ankur.
Any other question? Happy to answer, or we can all enjoy our Saturdays.
I guess we don't have any more questions on.
Sure, Isak, no problem.
So I'll just wrap it up on behalf of the organizing team. I'd like to express my sincere gratitude to our esteemed guest, Mr. Ankur Shah, for sharing his invaluable insights and expertise. The depth of his knowledge and the practical wisdom he has imparted will undoubtedly resonate with all of us. I encourage everyone to reflect on the key takeaways from today's discussion and apply them to their own journeys. On behalf of IIM Indore and the Alumni Office, I extend our heartfelt thanks to Mr. Shah and all the participants today. We look forward to more such enriching interactions in the future. Thank you, everyone, and have a wonderful evening.
Thanks, Vesak, and thank you, Institute, for giving me this opportunity.